Hey guys, welcome to Fellowship of the Frugal. My name is Daniel. In today's video I'm going to talk all about children's life insurance and whether or not you should get it. So I've had a lot of experience in this area as a life insurance agent. It's something I have personal knowledge of in the field, and wanted to share some insights. I'm going to look at 4 reasons why you should consider it, and I'm also going to look at some common objections that I have seen and read about from other parents that say they don't want to get life insurance on their child and why that is, and I'll answer some of those. So as always, if you like this video and gather some good information from it, be sure to subscribe, check out my other videos, and I'll be sure to keep pumping them out for you. Hope you enjoy. Thank you. Okay, so to start with children's life insurance, for your first decision is basically which type to get. Do you want to get a term or do you want to get whole life? So this video is geared more towards if you get a whole life. I will say briefly on term that usually with a employer policy, they have an option to add a child as a benefit for being an employee there, and usually like a $10,000 death benefit on a child is pretty cheap. I mean, we're talking pennies per paycheck, and so to me it's a no-brainer to go ahead and add that. And a lot of them will have an option to cover multiple children for the same cost, so you can always look at your employer benefits on that to see what's offered. And also, if you have an insurance policy of your own, you can look and see if you can add a child as a term rider, which is usually a possibility. And the term insurance is pretty cheap. It's better than nothing. I'm going to get into why I think a whole life option would be the better fit. But if it's cost, or if you don't buy into the idea of getting a whole life on a child, then you do want to get the term policy, like I said, because it is cheap and it does provide a death benefit in case the unthinkable happens. So that's all I'll say on the term part. So on the part talking about why you should consider it, the first reason is because it locks in insurability. Now what I mean by that is some companies will have the option to get a policy on a child and then purchase the option to guarantee future purchases of insurance. So let's say you have a child, or let's say a family who has a chronic illness and the child may be prone to get that. Well, you can get insurance when they're a baby and lock in their insurability so that no matter what happens with their health, you can still be guaranteed to purchase additional policies for a higher death benefit as the child ages, usually starting around like age 19, 20, 21, somewhere around there. And for different intervals, you can be guaranteed to buy additional coverage, so that as that child probably has a family of his or her own and has a greater need for life insurance, but they can't get it on their own outside of what you've already done, then you have the option to do that. And it's only not based on health, but also on occupation. Some occupations, like if you're a professional skydiver, those are pretty high risk, and you may not be able to get insurance outside of anything that's already provided. And so what this option does with the guaranteed insurability is it also takes your occupation off the table as well. So regardless of health, regardless of what you're doing in life, you could even be one of the people traveling to space by that time, which is probably considered a high-risk activity, and you can be guaranteed to still buy that coverage. So that's a big reason for getting it. I know in my own family, we have a chronic illness that makes it a high likelihood that one or more of my kids may inherit. And so locking in that insurability was important for me, so that regardless of what they do in their future with their own families, that at least the insurance piece is covered and they don't have to worry about that. So a second reason for considering insurance on your child is the cash value growth. Now I'll get to the objection on this later, but just for the positive reasons to get it now is there is cash value accumulation in the policy, which means you can use it for whatever you want to. Now some people like to set this aside for, say, college funding, and one thing about that is if that's what you're planning on doing, the cash value that's inside the policy does not count as assets or as income towards, say, a student loan application. So that's taken off the table, unlike some other vehicles that you may have when you try to apply for a student loan, is that asset is taken off the table. So don't have to worry about that. And then on top of that, even if you don't end up using it for college, you can use it for whatever you want. There's really no limit to what you can do with the cash value should you need it in case of whatever circumstances. And even if you want to turn it over to the child one day, you can do that as a gift at age 18 or 25 or whatever age you determine. As the owner of that policy, you can turn it over and then leave it as a gift. And it's not just for the parents in this case. In fact, the third reason you should consider it is you can give it as a gift. This even applies for grandparents as well. Grandparents, you can buy a policy on your grandchild. Now, the parent will need to be the owner on the policy, but you as the grandparent can be the payer. So instead of getting, say, a savings bond where you're not sure what's going to happen with the value, if it's a good investment or whatnot, you can consider buying a life insurance policy on your grandchild, and then hopefully they live to an age where you can one day turn it over to them, and you can just turn it over and there's cash value in it, and you can use whatever you want. Love grandma and grandpa. It's a great idea to consider because cash value is flexible. The gifting would be a tremendous gift, a tremendous asset to turn over to them. At that point would more than likely be able to pay for itself. Well, in some cases, there are some exceptions to that obviously, but there's a lot of flexibility there, which is one of the reasons that I like it. So gifting is another reason to consider this. And the fourth reason to consider this, especially the younger they are, the better rate they're going to get. So each year older that you get, your insurance cost goes up a little bit. So say if you're 1, your insurance may cost $20 a month for whatever you're getting. But if you're 2 years old, it may cost $20.50. If you're 3, it may cost $21. Of course, you'll have to get with an insurance agent to really flesh out the numbers, but it's just going to go up a little bit each year. And so the sooner that is locked in, the less that rate is going to be. So the more money goes towards things like cash value and potentially increased death benefit. Now, what I mean by that is, depending on if your insurance company allows you to participate in dividends, you could use those dividends to then buy little incremental increases in the death benefit without any increase to your premium. So if you buy, say, a $50,000 or $100,000 policy up front, by the time the child reaches age 20 or beyond, it's going to be worth more than that. Maybe worth $120,000 or $115,000. It just depends. But it can grow as, think of it as a sort of inflation protection in a way. It may not be perfect, but it's kind of built in there for some increased death benefit. So it's not just that level $100,000 the whole time. But you'll have to check to see if your policy you're looking at offers that. Some do, some don't. You'll just have to ask. And I will say, to wrap up this section, these are reasons why I personally believe in this, and I personally have bought these on all of my children and will continue to have them until I determine they're ready for them at some point in the future. They're still very young now, but when they reach an age where I feel like, hey, this can be your responsibility now, turn it over to them and let them do what they want. So not only am I talking about common reasons for doing this, I'm talking about reasons why I personally did this. So let's look at some of the objections that I hear. The first one, the most common one, is a parent will say, well, I don't want to profit from my child's death. Well, I certainly understand the thought behind that, and I agree. What parent would want to profit off of their child's death? It's the unthinkable. Can't even imagine something that painful happening. Of course you don't want to profit from it. The reason I would push back against that is because I would say you're looking at it in the wrong way. One thing to consider is that if a child were to pass away, you would be so grieved, so devastated, that more than likely you would spend more money than you would if you were in a right frame of mind on things like the funeral and things related to that. Now, before I got into the financial business, I actually was in the funeral business, believe it or not, and I've been a part of planning and stood present for numerous funerals for children. Now, typically speaking, those were going to be the most expensive services by themselves, and then afterwards the monument that goes in place is usually more expensive than you probably would have gotten for an 88-year-old that passed away. It's just part of the grief of the parents. So when you say you're going to profit off a child's death, more than likely you're going to pay more for a child's funeral and related expenses than you would for anybody else anyway. So the chances of there actually being a profit are very slim. But even taking a step further, there's so much that could be involved with hospital, with funeral, with after expense, with lost wages, with lost time off job. I mean, you could be in so much devastation you would lose your job. And so you don't know what all is going to happen. And for very minimal difference in premium, you can purchase a lot more to try to account for some of those things. God forbid they actually happen. Of course, you hope that they don't happen, and that's the goal, is you hope they don't happen, but have something in place just in case it does is not a bad move at all. Another objection that I commonly hear is, well, my kids will buy their own. Why should I have to buy theirs for them? Well, for this, I would point back to my point earlier on locking in insurability, and also a maturity thing, because a child, when they say they're 18 and move out of the house and then they're on their own, they may not even consider buying life insurance until they're much older, maybe have a family of their own. And what if their insurability is a question at that point? By going ahead and locking it in earlier, then should they grow up, be healthy enough to get their own insurance, and that's great, that's what you want. But just in case that doesn't happen, then you've taken the steps to guard against that ahead of time, which is part of our responsibility as parents, is to do the best that we can to set our kids up for success down the road. So whether or not they are insurable or not, you've still done what you can based on the information that you have to set them up in a favorable way for that. The third objection that I commonly hear about child's life insurance, now this applies more towards college funding aspect, but if you are planning on using the life insurance to fund college, it's not going to have that much value by the time the child reaches college age, and for that I would agree. And so a person may say, well, I'd rather do an education IRA, or I'd rather do a 529 plan, or just regular investments instead. So that would be a better strategy for college fund growth. Earlier I mentioned that if you have to do a student loan application, then those vehicles would actually come into play on the application, whereas the cash value in a life insurance policy can be left off. It doesn't have any factor at all on eligibility on a student loan. And so that's something to consider. But really, if you're looking at using life insurance to help fund college, the better idea would be to put the insurance policy on a parent and then let that provide future funding, because the growth is going to be much better than it would be for a child. So while I said earlier that you can use the cash value for many things, and that's true, if you're using it strictly for college and thinking you're going to fund all of college with it, that's just not going to happen. It can provide some supplemental, but it's just not going to be enough. But there are ways to do better with that. And so for the college funding objection, I would say yes, don't rely on your child's life insurance policy simply to fund college. This is not going to be enough. So a fourth objection that I hear is that the policy is not going to grow much. So in comparison to, say, an adult's policy, who may pull one out at 21 who's healthy, absolutely, the premium is going to be higher on the adult and the growth is going to be better. So with life insurance companies, just as kind of a primer on how the rating system works, you'll have your super healthy people, you'll have your average health people, and then you'll have your substandard or non-healthy people. Usually with a child's policy, that's going to be classified somewhere in the middle. That's kind of an average health rating. And so part of the reason it doesn't grow as much is because it's not going to have the same cost of insurance as somebody who's in the super healthy category. And you usually have to be at least 21 or so to be able to be eligible for something like that. So hypothetically, if you have a child who grows up to be 21 or whatever the age is for the company and is super healthy and gets their own policy with a comparable premium, yeah, it would grow better just because of the rating that they have. The cost of insurance is less. But that doesn't mean you should discount the whole thing altogether for the reasons that I stated earlier on some of the benefits of getting it, because you can one day gift what is there to the child, but you don't buy it simply to hand over everything that they need, period, when they get to be adulthood. It's just kind of a supplement on top of everything else that you've taught them and maybe any other gifts that you give them. This shouldn't be the whole strategy. I'll never say life insurance should be the whole strategy. It's just a supplement for it, and it's at least a guaranteed portion of it versus investments or any other vehicle which can gain or lose value. Life insurance is not going to lose value. You have a contractual guarantee on that, and then a projection of what is probably going to happen based on the current market conditions when you take it out, but you know you're at least not going to lose value on it. And then the last objection that I'll talk about is the death benefit itself being small for adulthood. So what I usually see with a child's life insurance policy, the death benefit may be $25,000, it may be $50,000, or it may be $100,000. Those are the most common ones that I see. So if you get a child's policy for say $25,000, that may seem like a lot for a child, but then if they reach age 25 and you want to turn it over to them one day, and let's say it's a non-participating policy, so it still has $25,000 death benefit, you may think, well, that's not very much. And I would agree with that. The good news is you didn't have to use the policy. That's a big plus there. You didn't have to bury a child. But the bad news is you don't have as much growth as you would have hoped. But as I said in my last answer to the objection, you want to put other things in place if you really want to give a larger financial gift to a child. But insurance, and an insurance policy, is a good gift to give, even if it's not simply for the death benefit down the road. You can buy a participating policy that grows, and you can also purchase more on the front end, say $100,000 instead of the $25,000 policy, so that in the hopes that one day when you do turn it over, that death benefit is worth more than the $25,000. So it still may not be enough for a situation where your child is married and has 1 or 2 kids. $100,000 is way less than what that person needs, but at least there's something in place, especially when you bring up the question on occupation, when you bring up the question on insurability, on health. That's always going to be a factor in everything that all throughout this video. That insurability thing is going to be a factor, so I'm always going to come back to that is an important piece on why to consider this, because you never know. And even the things that have happened since COVID, the things we've seen that happen to young people with heart conditions and things of that nature, this is all the more reason to consider it. Because even when I first was in the industry, that wasn't even on the table at all, but our world has changed quickly, and our world is continuing to change. So if you have something like that in place with a decent death benefit that you can one day turn over and guarantee insurability, then that's all the more protection against the what ifs in life, in society, that you just don't know what's going to happen. So when we plan for things financially, whether it's insurance, investments, whatever, we have to plan based on what we know now. And so one thing that a child policy does is it provides protection against all these what ifs, because we just don't know. I can't tell you what's going to happen tomorrow. Nobody can. So it covers a lot more of those what if scenarios that may cause something to happen that you never saw, but at least that level of protection is in place. So with all that being said, I am a fan of a whole life policy on a child. I think you should consider it. I hope that the reasons that I've given for it and the objections that I've answered can help clarify some of it. If not, there's going to be some more material available for you. But again, one thing I'm stressing is it's part of a strategy. It's not the whole thing. If your goal is to turn over a huge sum of money to your child one day, this isn't the way to do it. The idea is you're protecting you and your family against, God forbid, something happening to a child, but you're also putting something in place to where if they do live, which is what we all hope as parents, if they do live, that there's something in place to hand over to them one day, whether you're the parent or the grandparent. There's something in place that you can gift over to them, whether they use it continuously or not. It's going to be on them, but at least you've done your part based on what you know today. As always, I hope you gained some value from this and maybe prompted a thought or two that you hadn't considered with child's life insurance. If you have any questions, leave them in the comments and I'll answer them as best as I can. And be sure to check out my other videos on other topics, and I hope to see you again soon. Thank you.